Welcome back, Adam here, and today I'm looking at furnished holiday lets. In particular, what the criteria for being classed as a furnished holiday let are, and I'm going to tell you some of the advantages and the disadvantages of gaining this classification for your rental property. Before we get into it today, don't forget to like the video and subscribe to the channel for more helpful tax content. I'm also going to link down below to our webpage where you can find more useful tax calculators and tax content. Now, a furnished holiday let is a property that is let out for short-term lets rather than the traditional longer-term let. And in the eyes of HMRC, doing so means that you are running your property more like a business compared to the traditional long-term lets where they view it more like an investment. And having HMRC view your rental property as a business can be very beneficial because there are certain tax advantages that FHLs or furnished holiday lets get access to where a traditional rental ordinarily wouldn't. However, there are also some strict criteria that need to be met in order to treat your rental property as a furnished holiday let. Firstly, it must be situated in the UK or the European Economic Area. It also has to be a furnished property and it has to be let out commercially, meaning you intend to make a profit from it. On top of that, you'll also need to meet the occupancy related conditions that are specified by HMRC. The first is known as the pattern of occupancy condition, which says if the total of all lettings that exceed 31 continuous days is more than 155 days during the year, this condition is not met, so your property will not be a furnished holiday let for that year. So letting a property for 31 days to 5 different occupants in the same tax year would automatically exclude your property from being a furnished holiday let. Essentially, this condition is just a way for HMRC to ensure that you are using it for short-term lets rather than long-term lets. The second condition is known as the availability condition, which states your property must be available for letting as furnished holiday accommodation letting for at least 210 days in the year. This could be achieved by having it listed on Airbnb or Booking.com or similar sites. But when calculating the number of days that you make it available for, you cannot include days where you are staying in the property yourself because HMRC don't deem it to truly be available during this time. The third condition is known as the letting condition, which states you must actually let the property commercially as furnished holiday accommodation to the public for at least 105 days in the year. When calculating the number of days, again, you're going to need to exclude any period where you've let it continuously to the same occupant for a period of 31 days or more, unless that was caused by unforeseen circumstances such as illness or a natural disaster. You would also need to exclude any days where you yourself have stayed in the property or allowed your friends to stay there for free or possibly at a reduced rate, because again, this isn't considered to be commercial. Any lets need to be at an arm's length. Now, with this third condition, the letting condition, if you weren't to reach the minimum number of letting days, then you still have a chance to qualify via 2 elections that can be made. The first is the averaging election, which is useful for people who have multiple properties in their portfolio. Essentially, it allows you to add up the total number of letting days across all properties and then divide it by the number of properties. So if you had 3 properties, 2 of which had 175 letting days, but the third only had 100 letting days, then by taking an average, you actually get 150 days per property, and all 3 could qualify as furnished holiday lets. Without making this election, the third property with only 100 letting days wouldn't ordinarily qualify. The second election is known as a period of grace election, which states you may genuinely intend to meet the letting condition, but you were unable to. If this happens, you may be able to make a period of grace election that allows the property to qualify as a furnished holiday let, as long as the pattern of occupation and the availability conditions were met, which were the first two conditions that we looked at. To make an election, you must be able to show that you had a genuine intention to let the property in the year. For example, where you have marketed a property to the same or a greater level than in previously successful years, or where the lettings are cancelled due to unforeseen circumstances, including extreme adverse weather. You can make an election where the property met the letting condition in the year before the first year you wish to make a period of grace election, either on its own or because of an averaging election. If your property again does not meet the letting condition in the following year, you can make a second period of grace election as long as you made an election in the previous year. If your property does not reach the threshold by the fourth year, after 2 consecutive period of grace elections, it will no longer qualify as a furnished holiday let. Now, that may sound like a lot of jargon to get your head around, but really what they're saying is that providing you've qualified as a furnished holiday let in the year prior to making the period of grace election, and despite marketing the property in a similar way for a similar amount of time, you just weren't able to let it for the minimum 105 days, you should then be able to use this election to maintain your FHL status for up to 2 years. But in the third year, you would lose your status if you don't then meet the 105-day letting required by condition 3. It is possible for someone who owns multiple properties to use both of these elections, the averaging election and the period of grace election, if necessary, to get through a period of time where a property wouldn't ordinarily qualify as a furnished holiday let. This might involve making an averaging election in year 1 and then a period of grace election in years 2 and 3, meaning you wouldn't actually lose your status until year 4 of not meeting the minimum number of letting days. Typically, these elections are made via the property pages of the self-assessment tax return. So assuming that your property does meet the criteria of a furnished holiday let, then you'll be able to access some additional benefits. Here are some of the most significant benefits available. Being able to claim capital allowances on furnishing your property. In the case of furnished holiday lets, the initial purchase of furniture and furnishings is an allowable expense when calculating your taxable profit. As you can imagine, this can represent a large amount of expenditure, as typically a landlord will spend a lot more making a holiday let look appealing compared to a longer term let. So this can result in a significant tax saving. Longer term rentals are not allowed to claim the initial purchase of furniture and furnishings as an allowable expense. As well as that, furnished holiday lets also benefit from mortgage interest relief. For me, this is arguably the biggest benefit of being classified as a furnished holiday let. Any financing costs such as mortgage interest payments are an allowable expense for a furnished holiday let. Just remember though, it's the interest payments that can be deducted from rental income when calculating taxable profit, not the capital element, as this part isn't a financing cost. Again, this results in a lower tax bill, and it is not the case for longer term lets, although longer term lets do usually get a tax reducer, but unfortunately, if you're a higher rate taxpayer, it isn't nearly as effective, making the furnished holiday let much more attractive for higher earners. Another benefit is that rental profits count as relevant earnings for pension purposes. This again is because HMRC treat a FHL more like a business rather than an investment. So rental profits from a furnished holiday let are considered to be relevant earnings for pension purposes. This usually means you'll be able to contribute more to a pension and still benefit from tax relief on those contributions. This is is a particularly handy benefit for those approaching retirement age and looking to top up their pensions as much as possible, and it makes the FHL look far more attractive than a longer term let. Owners of furnished holiday lets will also benefit when they come to sell their properties, as they may be able to benefit from certain tax reliefs that are available. These include business asset disposal relief, which would potentially allow any capital gain you make when disposing of your furnished holiday let business to be taxed at a reduced rate of 10%, providing it qualifies. Compare that to a maximum rate of 28% for high earners, and that's a significant saving. A furnished holiday let may also qualify for business asset rollover relief, which applies when you dispose of one business asset and use part or all of the proceeds to purchase a new asset. Essentially, you roll the gain into the new asset, which is a way of deferring your tax liability. And finally, gift holdover relief, which applies when you gift away your business asset, in this case your furnished holiday let. The gain that you might ordinarily incur is passed on to the recipient of the gift and would be realized when they dispose of that gift. All three of these are very useful for capital gains tax planning. And finally, it is also easier to split profits in a tax efficient manner with a furnished holiday let. The owners of FHLs may find it easier to split profits in a way that is beneficial to them from a tax standpoint. So if a property is jointly owned, it can be possible to attribute more of the earnings to a lower earner to benefit from lower rates of tax, providing you can demonstrate to HMRC that the amount of work input to the business is split in a similar way. This is not the case for longer term rentals, where profits are usually split in line with legal ownership. So there are clearly a host of benefits to gaining this classification, but it wouldn't be fair to only focus on the benefits, so I'll point out a few of the potential disadvantages too. From a tax standpoint, there is a potential requirement for VAT registration. Now, this won't apply to everyone, as the VAT threshold is £85,000 of turnover, but it's certainly something to be aware of if you own multiple furnished holiday lets. If you were to exceed that threshold, then because HMRC are treating you like a business, VAT registration would usually be compulsory, which can add to your admin burden, but more importantly, it can mean that you need to charge VAT to your guests, which can be detrimental to the business overall. Of course, if your turnover is below 85,000, then VAT registration is not required, although it can be done voluntarily if the owner thinks that it would be beneficial. And then a second disadvantage is not tax related, but it's the amount of work involved. There is a reason why HMRC treat a furnished holiday let like a business, and that's because to be successful, you need to run it as one. There's a considerable amount of time, there's cleaning, there's advertising, there's wear and tear to deal with. All of this is on a much greater scale than a longer term let, where you could potentially have the same tenant for a number of years without any issue. So you can see from this that there are a large number of advantages, most of which are tax related, but there are also some disadvantages too. I'm going to link down below to our article covering furnished holiday lets for anyone who is looking for more information. That is all for today. I hope you found that useful and now understand the qualifying criteria and tax benefits of the furnished holiday let. If you have any questions, drop them down in the comments. Thanks for watching. See you next time.